Hello, I'm Carolyn Herbert from the Finance News Network, and joining me from Fat Profits to discuss what's going on in the commodities space at the moment is resource analyst David Lennox. David, welcome to FNN.
Thanks, Carolyn, for having us.
It's without a doubt that commodities prices have really hit the skids over the past 6 to 12 months, but are we going to be experiencing more pain in 2016? What are your thoughts?
Look, 2016 we think you'll have to split into two halves. The near term, where we do think there will be more pain, primarily because China is still showing signs of slowing, and also the US dollar may continue to rise on the back of the expectations of further interest rate rises in the US. However, in the second half of the year, and maybe towards certainly the latter part of that second half, we would expect that perhaps China will have stabilised, because we do expect to see Chinese authorities actually manipulating their stimulatory policies in the early part of the year, and that will stabilise the Chinese economy. And of course, with the US interest rates, we think the Fed will, what we call gradualism of raising interest rates through 2016, and that we believe will put pressure on the US dollar on the downside. With those two factors in place, we think that will certainly take some of that pain away that we will see in the first half for commodities, but we aren't expecting to see any significant rallies throughout 2016.
Now, David, taking a look at iron ore specifically, the price of the commodity is around the $40 per tonne mark. What range do you think this is going to be trading in, and do you think we've hit the floor yet?
Yes, look, we think we've hit the floor. We think iron ore through 2016 will trade probably between $38 a tonne US up to $60 US a tonne US to actually close the year out at around its highs of $60. The reason we say that is because if you have a look at 2015, China imported a record 953 million tonnes of iron ore. That's up 32 million tonnes on 2014. In 2016, we expect China will import something like near on 1 billion tonnes of iron ore. The reason they're importing such a huge quantity is primarily because they want to conserve their own home iron ore, and also they believe they can get cheap 62% fine iron ores at a very good price from the import markets. So that's why we basically suggest that through the latter part of 2016 we will see a very strong rally in the iron ore market.
Now, BHP has hit 10-year lows in terms of the share price and is trading between that $14 and $15 range. Do you think it has further to fall, or is it good value at these levels?
Look, if you have a look at the PE for 2016, it's trading on 22 times with a dividend yield of just over 10%. We do think that perhaps in the near term is not quite so sustainable, so we may see BHP continue to fall, but we think those falls will be very shallow. However, if you have a look out longer term, and we do think that there is very good support longer term for the commodities markets, and particularly iron ore, as we've just mentioned, and oil, as we will be talking about shortly. If we see positive movements in those markets, the work that BHP's done throughout 2014-15 to reduce its costs, get its operations into order, that will leverage the company very well into what we believe could be a stronger commodities cycle in the latter part of 2016. That will eliminate the pain of the early couple of months for BHP, and we could see that stock rally quite strongly in the latter part of the year.
The price of oil has tumbled like a lead balloon over the past 6 months. What can we put the price plunge down to, and where do you see it going over 2016?
Well, the price plunge has been with us now for well over 12 months, and that's primarily on the back of the fact that we have seen that market in oversupply. In 2015, that ranged between about 1 million barrels up to 2 million barrels of extra supply that the market just didn't want. In 2016, we believe that the supply excess is now about 1.5 million barrels, and we think throughout 2016 that excess will start to actually diminish back to, we believe, about 500,000 barrels, primarily on the back of the fact that we do believe we will see a rational response by the supply side, and we will see production starting to be closed in, primarily because high costs will obviously start to eat into profits. And of course, we've seen a number of countries now actually rationalising their social policies, and we think those are unsustainable. So production cuts will come in later in the year, and that will lift, we believe, the oil price up to a range of about $50 to $60 closing in 2016.
And finally, David, what's your outlook on the gold price, particularly given the economic turbulence that's going on in the world at the moment?
One would have thought that with such economic turbulence we would have seen the gold price actually rally as a safe haven. And we do think that in 2016 that gold will actually rally, and we have got a closed price of about $1,300 US an ounce for the end of this year. We have that price primarily on the back of the fact that we do believe that later in the year, once the markets do become accustomed to the fact that the Federal Reserve is actually in that gradualism mode of lifting US cash rates, that will see the US dollar weaken. On the back of that US dollar weakening, we do think gold will have quite a strong rally. That's the reverse of what we saw in 2015 when the US dollar was rising and gold falling. Add to that, unfortunately, we've seen an escalation in geopolitical events, and we do think that that may perhaps start to push investors back towards gold as a safe haven. Add those two factors together and we think gold will do quite well through 2016.
David Lennox, thanks for your insights on the commodity space.
Carolyn, thank you very much.